Do you know how the stock market works? The stock market can act both as a primary market and a secondary market. In this video, you will learn how these markets work and how they relate to individual investors. The primary market is where securities are created. It is the place the firms sell new stocks and bonds to the public for the first time. An initial public offering, or IPO, is an example of a primary market. Before an IPO, a company is considered a private company, usually with a small number of investors like founders, friends, and family. To raise more money to grow, firms can issue an IPO. When a company goes through an IPO, the general public is able to buy shares and own a portion of the company. Therefore, an IPO is often referred to as going public. Here are some biggest IPOs in the US. In November 2010, General Motors IPO with $20.1 billion raised. In May 2012, Facebook IPO with $16 billion raised. In September 2014, Alibaba Group IPO with $21.8 billion raised. To a firm, IPO is the end of one stage in a company's life cycle and the beginning of another. However, going public is a challenging, time-consuming process that is difficult for most companies to navigate alone. In this process, a private company has to file a ton of paperwork and financial disclosures to meet the requirements of the Securities and Exchange Commission, which oversees public companies. That's why a private company that plans to go public hires an underwriter, usually an investment bank, to consult on IPO and help it set an initial price for the offering. Underwriters help management prepare for an IPO, creating key documents for investments and scheduling meetings with potential investors, called roadshows. Once the company and its advisors have set an initial price for the IPO, the underwriter issues shares to investors, and the company's stock begins trading on a public stock exchange, like the New York Stock Exchange or Nasdaq. On the other hand, the secondary market is where those securities are traded by investors. Different from the primary market, in the secondary market, investors trade among themselves without the involvement of the issuing company unless it buys back shares. For example, if you go to buy Facebook stock, you are dealing only with another investor who owns shares in Facebook. The secondary market does not provide financing to Facebook because Facebook is not directly involved with the transaction. The amount received for security in the secondary market is income for the investor who is selling the securities. In coexistence with all the large investors, retail investors usually acquire shares through a broker like Vanguard and TD Ameritrade. The primary and secondary markets are different in several ways. First, the primary market is where securities are created, whereas the secondary market is where those securities are traded by investors. Second, the primary market provides interaction between the company and the investor, while the secondary market is where investors buy and sell securities from other investors. Third, the primary market prices are often set beforehand, while prices in the secondary market are determined by the basic forces of supply and demand. If the majority of investors believe a stock will increase in value and rush to buy it, the stock's price will typically rise. If a company loses favor with investors or fails to post sufficient earnings, its stock price declines as demand for that security dwindles. So, as an investor, should you invest in IPOs? You may have read stories about people making bundles of money on IPOs. However, there are many more stories that go the other way. In fact, more than 60% of IPOs saw negative absolute returns after 5 years. As such, putting your money into an IPO carries more risks than buying the shares of established public companies. Since there is less data available for private companies, investors of IPOs are making a decision with more unknown variables, making it much riskier. For example, in March 2019, Lyft went public at $78.29 per share. The stock price dropped immediately after IPO. And even today on June 6, 2022, the stock price is $17.60, with a 76% drop. If you had bought in when Lyft went public, you still wouldn't have recouped your investment by today. Just because a company goes public doesn't necessarily mean it's a good long-term investment. If you want to learn more about how to determine if a business is good or bad, please subscribe to my YouTube channel for more updates. If you are interested in the exciting potential IPOs, a diversified lower-risk approach is suggested. This strategy usually requires a diversity of holdings by investing in hundreds of IPO companies. Some IPO ETFs are good options. For example, Renaissance IPO ETF has returned 18.35% since inception. First Trust U.S. Equity Opportunities ETF has returned 13.92%. These two IPO ETFs are good performers considering that the S&P 500, a major benchmark for the U.S. stock market, has seen average returns of about 10% for the past 100 years.